All right, I'm going to go ahead and kick us off. I think we have got a few texts here, a few more guys that'll be joining us here shortly. But well, guys, it's my thanks for joining us today, everybody. It's my pleasure to introduce Jeff Faine to you, and I'm going to go ahead and get the bad part out of the way first. Jeff, as some of you know, did play his college ball at Notre Dame. And, Jeff, I don't know if you know this, but I did visit South Bend once, and it was back in 1995. And if my memory serves me correct, there was a historic upset that day suffered by the Fighting Irish at the hands of my lowly Northwestern Wildcats. So I didn't know if you knew that little bit of history, but I was there for that. Good news then, Jeff followed that stint with a long and successful career in the NFL, probably played for some of your favorite teams, played for 4 different teams. Here's why I partner with Jeff. He is among the top advanced planning design experts in our industry, far and away. He's very, very good at what he does, innovative, has integrity, it's fun to work with. And that's why Jeff and I partner together and have a lot of fun doing so. Today, our primary focus will be on ETA, the Enhanced Tax Advantage. And think of ETA as a way to dramatically improve the outcomes for your clients who have a significant pile of retirement plan money. Not only does ETA solve the tax problem on your client's qualified plan money, but it also deals with market risk, gets rid of RMDs, gets rid of IRD. And so Jeff is going to show us how and why the ETA strategy beats staying in a 401k or an IRA. He's going to show us how and why it's better than a Roth conversion. And then towards the end, we're going to transition to another strategy called enhanced pension, which serves as an alternative to defined benefit and cash balance plans. One last thing, and I think we'll get to this again towards the end, you will see that embedded into the ETA and EP strategies is Jeff's software that all by itself is worthy of introducing in this webinar. It is the best way, maybe the only way that I have seen that allows us as advisors show our clients what IUL can do. Now, ever since the AG 49 regs hit, which in my humble opinion have had a drastic and negative impact on our ability to show clients what it is they're buying and what it is they're building their financial futures upon, this is one of the few, maybe the only clear way to demonstrate the real and true benefits of what we can do for our clients when we use IUL. So with that, Jeff, go ahead with any introductory remarks that you have or any housekeeping matters, maybe how you'd like people to ask questions today, the best way to do that, and then get us started.
Absolutely. First and foremost, every time I have a conversation with Rich, guys, Rich reminds me of Northwestern going to.
Have I done that before?
No, yeah, no, I've heard that a few times. So I appreciate everybody's time today. I think what would be helpful as we go through the information, I'm gonna try and keep it high level. First and foremost, we're going to dig into a little bit of the details of the programs, but I think what would be helpful is that if there's something that you guys want to see a little bit more in detail, want to learn a little bit more about it, if we have a little bit of time at the end, we can certainly dive into a little bit of the actual mechanics of how things are actually situated. I think we got a small enough group here right now that it makes sense that if you have a question, there's a chat box that you can certainly jump in, drive it in there, or if you're not tech savvy and you want to just interrupt me, please feel free to say, hey, hold on, pause, give me a second to ask a question, because you might have a question that frankly someone else might have as well. So don't hold them until the very end. is all I'd ask. So I appreciate everybody's time. We're going to jump right into it and be mindful of everybody's time here. I'm gonna keep it cruising. There's going to be some concepts here that we're going to cover that, frankly, everybody on this call might have good familiarity with, but I'm going to just make sure we cover the basis. And also too, this is, I think, gives some good insight on how we present to clients, on how we educate clients, really kind of give them some good understanding of what potentially, the potential pitfalls they might be dealing with that they don't really have good clarity on right now. As Rich mentioned, I'm just going to give a real quick, a little bit of additional background just so you guys know where this is coming from. I had a 10-year NFL career. During that time, I purchased a premium finance life insurance policy. Now, what's interesting is the strategies we're going to talk about today have financing components to it, but we're not financing any premiums. But conceptually, there are some things that align there that I certainly brought from my experience as a client. As we kind of moved forward, and I got into this business as a professional, I continued to essentially drink the Kool-Aid, right? We have two policies on my life, a policy on my wife's life, and then two policies on my son's lives, Kai and Breck. I'm actually going to bring Kai and Breck back into the conversation here, into the presentation here in a little bit. But this is just showing that, we're fully invested, one, but also two, extremely familiar and comfortable with utilizing life insurance in different ways, utilizing leverage connected to life insurance. And we're going to talk a little bit about that more here as we walk through this. A lot of our focus with our firm is really more focused on not necessarily retirement planning, but more so of planning for retirement income. And so a lot of the strategies that we're going to talk about today are focused on that piece of the retirement picture. I think there's a lot of effort and thought put into retirement planning, how to accumulate as best as we possibly can, but not enough effort is really put into the decumulation piece of it, where we look to be able to distribute funds over a lifetime of savings and to be able to create as much of a beneficial picture for families, for individuals, for legacy, however that might be approached. There just isn't enough really focus put on that, in my opinion, in the industry in general. But we're going to focus on it today. So first up, as Rich alluded to, we're going to talk about two solutions. The first one being enhanced tax advantage. We use this to be able to create efficiencies out of tax events. So any type of tax events like distributions from qualified plans, selling of a business or other type of asset where you might have capital gain tax liability related to those assets. So think of even selling real estate and not necessarily considering a 1031 exchange, trying to create a different way to be able to approach that tax liability. And then also too with lump sum tax liability, so any type of ordinary income tax liability. So, but what we're going to focus on today is qualified retirement plans, distributions from qualified retirement plans, and or in comparison, what would it be like keeping the assets in the qualified retirement plans? What are the problems? What are the pitfalls? What are the issues that folks might come across? And this is the fundamental pieces that I think that I just want to make sure we're covering all our bases here. Again, this is how we educate our clients. These are taken directly from client presentations. I'm introducing back into this presentation here today. So we believe qualified retirement plans are great savings vehicles. We're not against qualified retirement plans. Great savings vehicles. You have great ways to be able to stash money away on a tax deferred basis, pre-tax contributions. Like all those things are great benefits on the way up the mountain, on the way up the hill as we're growing and building this nest egg. The problem really shows up on the back end, right? So qualified retirement plans are also terrible distribution vehicles. So as the money's coming out, how is that handled? How is that taxed? How is that dealt with? Tax deferred growth actually means growing tax liability. right? This is something that I think is highly overlooked, where we're talking about looking for the benefits of a qualified retirement plan, saving pre-tax, and having now that tax deferred growth. How does that impact long term? You have a growing tax liability that you're going to have to deal with. Income distributions, of course, are taxed on an ordinary income tax basis. You have a 10% penalty on any access to funds prior to 59 and a half in most cases. That's something that you're not getting access to your money without a 10% penalty. And then on the back end, if you get too old, they force you to take it out, right? And so there's some inefficiencies there that create some issues that is just not complementary to, you know, life sometimes. You know, sometimes life does not go on a normal schedule of what the government plans for us. Retirement account is exposed to losses in a market. So market corrections, you know, if anybody looked at the 401ks or IRAs in March of 2020, it took a decent hit, you know, and so these are some things to be able to consider when you're looking at qualified retirement plans. And then, of course, Uncle Sam's going to get his cut again on the way out, right? So you have ordinary income taxes on inherited retirement plans. So you're the next, you know, the next in line that inherits the qualified plan is going to have to deal with it within 10 years to be able to get the funds out. And then they're going to be hit with ordinary income taxes on those distributions. So those are the inefficiencies that comes along that I'm sure that all of us are aware with qualified retirement plans, but you'd be shocked when you find out and have a discussion with your clients how unaware they are of some of these issues. And especially as we look through here and walk through some of these examples, when we put numbers to some of these bullet points, you'll start to, it really starts to shine and really, you know, pulls the wool away from the eyes there. Before we get into some specific examples, we're going to talk about sequence of return risk. This is also something that I think, you know, when I mentioned this here, retirement account exposed to losses in a market, in a losses in the market, I think it sometimes is kind of glossed over with a lot of prospects, with a lot of clients, as they, you know, hear and understand what market risk really does to their portfolio. But what we're going to do is we're going to bring my sons back into the conversation. So we have Kai and Breck. Okay, they're 4 years apart. My oldest is 8 years old. My youngest is 4 years old. At some point, though, I can't even imagine it right now. At some point, they are going to retire in their lifetime, right? They're going to hit retirement age, maybe a better way to say it. And so what we're going to do in this example, we're going to have Kai and Breck. Kai's 4 years older, Breck's 4 years younger. We got a 30-year period that we're going to look at here. During that 30-year period, there's an average return of 13.68%. So they're both going to be able to exist in the same 30-year period. They're both going to have the same starting balance of $1 million. They're both going to take a $100,000 distribution rate, 10%. So when I first talk about this with clients, and I say 13.68%, what's a comfortable distribution rate? The first ask, what's the distribution rate? I say, okay, well, what do you think is a comfortable amount to distribute out? Well, if we're average returns 13.68, we should be able to comfortably take out 10%, no issues, right? I know all of us know that's not the issue here, though, but this is a real great way to be able to identify this. 3.68% average positive arbitrage, all right? Now, the 30-year period that we're going to look at starts in 1972. In 1972, Kai retires. So Kai retires in 1972. 13 years later, Kai is broke, taking that same $100,000 distribution rate with that $1 million balance. Breck, on the other hand, retires 4 years younger, being 4 years, or 4 years later, being 4 years younger, right? Just a 4-year difference. Breck has the same distribution rate of $100,000, takes it the entire 30-year period, and has $13 million left at the end of that 30-year period. The only difference was that he missed 1973 and 1974. That 4-year difference is a huge difference when it comes to the outcome of Kai and Breck's retirement, right? And that's the sequence of return risk. Now, what does that have to do? beyond the obvious of there being market risk and being exposure to the market? What does it have to do that's an additional thought here that we should consider? It's nearly impossible to time a retirement on the market. You're 70 when you're 70, right? The market is what the market is. You never want to sell when the market is down. But if you have RMDs, you have no choice. And so in that situation, you'd have double trouble. You're going to have RMDs that are going to occur during a down market, and you're also going to have ordinary income taxes to deal with on top of that. So you're selling when the assets have come down. And not only that, the government's going to take their cut on top of that. And so how does that impact a qualified retirement plan in the long run? How does that impact a retirement? Our suggestion would be to utilize a buffer asset, which is what we're going to obviously talk about today. Life insurance policy specifically. We don't really necessarily talk about the life insurance policy being the asset initially with clients, but that's what it is. We're all advisors here for the most part. And we're going to talk about this as we're going to use it as a buffer asset. We mitigate the exposure to market risk. We're going to talk a little bit more about that. We allow other assets to recover. Right? So we're going to take access to this buffer asset, allow other assets that are fully exposed to the market to recover and come back and be able to maximize an outcome for a retirement income. All right. So enhanced tax advantage. Who's this good for, right? Folks, individuals that are looking to retire at some point, that are concerned with taxes from RMDs, concerned with future tax rate risk, impact of taxable distributions in IRMA. This is one that's becoming more and more of an issue, and that a lot of people are not putting much stock into and much understanding of, in my opinion. So the impact on Social Security, the impact on Medicare, the Medicare premiums that are going to be required due to the income taking from qualified retirement plans, right? That's ordinary income. It's put into the calculation. And ultimately, there are folks that are receiving letters that their benefits are going away. Inherited qualified plans. So folks that have inherited qualified plans, received an IRA, inherited from mom and dad, and now I got 10 years to figure it out. And I got to pay all this tax to figure it out. Well, we have a way to be able to help them and create a little bit better outcome for them. So enhanced tax advantage, we're going to utilize tax liability in the solution. So it's going to participate and compound and grow for life. Tax sheltered growth. Life insurance policy has tax sheltered growth, right? Access to income tax-free and penalty-free without age limitations. Guaranteed downside protection against market risk. Remaining value inherited tax-free. Okay, here's an example. It's a 50-year-old. We're going to use the previous 40 years. So 1984 rolling up to 2023. This gets in a little bit of what Rich mentioned about our ability to be able to back test and look at different assets. We'll compare different assets in different time periods. We're looking at the previous 40 years here. We also can look in, that 30-year period that I just mentioned with my sons, right? The worst, that was happened to be the start of the worst 40-year period in the last 50 years. Okay, we can look at, and frankly, we've been able to do this with folks giving us Monte Carlo simulated sequence of returns and all kinds of things. But what we're going to focus on here today is the previous 40 years for this particular presentation. Previous 40 years, we're assuming a 37% tax rate. We got $1 million qualified account balance. Okay. Now, if we leave the money in the qualified plan, what's going to happen? At 70, we're showing taking voluntary distributions from the qualified plan, IRA, 401k, cash balance plan, whatever qualified retirement plan it might be coming from. $203,000 is taken as a taxable withdrawal. $75,000 of taxes on that taxable withdrawal. You have after-tax income of $128,000. Okay. By the time we reach the age 89, we pulled out $5.4 million taxable. paid $2 million in taxes, and you have $3.4 million in after-tax income. What's in the red box is what catches clients' attention. It's something that they haven't really thought of. They haven't put much stock in. They might understand and be comfortable with 203, and I'm paying $75,000 of tax on the 203 taxable income. That's just the penance for being in a tax deferred asset, right? But what they don't do is think about the cumulative effect of the amount of tax that they're going to pay on distributions from their qualified retirement plan. And that's with the assumption that tax rates do not increase. That's what this calculation is providing. Okay. Now, enhanced tax advantage, same 70 years old. We're going to take $200,000 of tax-free income. By age 89, we pulled out almost $5.4 million. We've basically almost replaced the tax liability that has been eroded from the value of the qualified retirement plan. Between there, 1.9 million in change of increase in income. Okay. Here's a little bit of the process, kind of step by step. Again, we can jump into a ledger at the end if we have time. Sometimes we get into situations like this with the presentation. It's a lot to dig into a ledger, column by column by column. But here we'll give you a little bit of a taste of the process. We're going to distribute the funds from the qualified plan. We're going to force taxation. Okay, $1 million distribution from the qualified plan. The bank is going to finance. So we're going to bring a bank involved. So the bank's going to be involved in this process. They're going to finance the taxes. Now here, this is a 50-year-old. And since this is a 50-year-old, I'm using a 37% tax rate. $1 million distribution, 37% tax rate. That's going to be $370,000 of taxes. But because it's a 50-year-old, we got a 10% penalty as well. This is done by, I'm showing this to you by design to show you that, like, really the penalty is not an issue. $470,000 of taxes and penalties are financed by the bank on the distribution from the $1 million. Insurance company is going to refinance the bank loan down the road utilizing a policy loan. The big thing, though, is that this entire $1 million is going to participate from day one. Total tax-free income, of course, is taken, we just saw this on the last slide, is almost $5.4 million. And the insurance company's loan is repaid by the gross death benefit. So the entire time, the tax liability and the penalty liability that is financed by the bank participates the entire lifespan of the insured. And the loan, whether it is the bank's loan or the policy loan that is refinancing the bank, is paid back out of the death benefit of the gross death benefit when the insured passes away. Okay. That's a lot there to digest. But this is a very, very efficient way, basically, for the client to retain more value from the asset that we're looking at here, right? Go ahead, Rich.
Jeff, question here. Having been what we've been through in the last 18 months or so with interest rates doubling or tripling or whatever they've done, there's always that sensitivity or that fear to interest rate risk. I know when I try and explain things using leverage to my clients, CPAs and other advisors, they're always pushing back with interest rate risk. How do you control or mitigate that in your strategy here?
Yeah, I don't have a slide in this presentation, unfortunately. So I'm actually what I'm gonna do is I'm gonna pull it because I want you guys to see this. I think it's helpful. I don't think it's in this presentation, so forgive me. But what I'm gonna do is actually pull a client presentation up real quick, and I'm gonna show you guys the slide on how I address this because I think that's a great point, Rich. I really do. So this is how we typically address it. It really comes down to 7% versus 37%, right? We're gonna finance the tax on the acorn rather than pay the tax on the tree. And really, when you're utilizing financing in anything really, but especially with life insurance. And here we're financing tax liability. I mentioned that, of course, I have a premium finance life insurance policy on my life. Um, the risk when it comes to interest rates is really long-term interest rate risk. It's not short-term interest rate risk. So where we are right now in an interest rate environment, first, whether or not you agree with me or not, I believe we're probably at the top of the cycle, and we're probably getting ready to go on the downhill of the cycle, right? And there's probably going to be some easing. I don't think anytime soon. Maybe in the next, call it 9 months, right? From there, it's going to improve the situation. But really, long term, what you have built in as a natural hedge is what I've already talked about. Going back to the presentation, it's really talking about the uh, the insurance company's policy loan. It's a built-in hedge in the life insurance policy. So you have a policy loan rate. Those are much less volatile than what you'll see in the market. You have carriers that are offering policy loan rates in the mid fours, even where interest rates in the market is north of 7%. You rewind 3 years ago when rates were in the market, and frankly in the twos and threes, policy loan rates were still in the mid fours. So there has not been much movement, even with the interest rates in the market. There has not been much movement with policy loan rates with the insurance carrier. And it really has to do with the fact that insurance companies can look much longer term than the market can, because they see their investments into bonds and everything like that into maturity. They're not necessarily trading that on a regular basis. And so that's what really keeps the availability for that type of access to interest, or excuse me, to policy loan rate as a hedge against market interest rates. So thanks, Rich. So I'm going to keep moving, keep scooting along here a little bit. When I talk about this here, talk about distributing $1 million, I talk about financing the tax and penalty. Sometimes folks make some type of alignment to a Roth conversion. So they might think about, hey, that kind of reminds me of a Roth conversion. Like you're taking it from a tax deferred asset to a tax-free asset. Yeah, you got to deal with a little bit of the penalty, or not the penalty, but the tax liability related to the conversion. So of course we're going to share here, what about a Roth conversion versus enhanced tax advantage? So with the Roth conversion, everything's still the same 50-year-old, same $1 million balance, same 37% tax rate. So the Roth conversion, you're not going to have to deal with the penalty, right? Because the government actually encourages you to do a Roth conversion. They want to get their tax revenue. So 70 years old, conversion's been done earlier, perhaps, whenever it's done, but the tax is $370,000 on the $1 million conversion, right? You're going to be able to pull out 3.4 and change. Coincidentally, if the 37% doesn't change, and if you leave the money in, the reason why you do a Roth conversion is you're concerned about future tax rate risk. But if the 37% is a constant, you're going to be able to basically get out the same money as if you left it in, right? If you have a long-term 37%, if leaving the money in and the qualified plan on the front end. So the math is all going to make sense here to be able to still consider to do the enhanced tax advantage. Right, we're going to be able to get out $3.4 million total income. We've paid the tax to the government of the $370,000 on the conversion. You pull out $3.4 million out of the Roth. In comparison, you're being able to pull out just short of 5.4 million. So we're still 1.9 and change above. And there's that whole pesky death benefit aspect that I haven't really even been touching on, right? That comes along with this. Why do people consider a Roth conversion? Eliminate future tax rate risk, tax-free growth, tax-free distributions. That's why you can run and consider a Roth conversion. You pick up all those benefits as well with enhanced tax advantage. You got the finance of the tax instead of paying the tax, though, right? Going back to the acorn of the tree analogy, you're going to finance the tax on the acorn, or you're going to pay the tax on the tree over time. So we've got a really cool, easy to use calculator that's accessible. We like to show it. It's right on your phone. I came up with this last year while watching the Masters. I said, man, I really wish I had something in my pocket that I can be on the golf course and really just kind of just have a conversation with somebody and explain to them the value of what we can potentially do for them. And so that's what we got at retainmorevalue.com. You know, you're sitting with a client, talking with a client, you're at the golf course, you're at the airport, you're at the, I don't know, the lobby bar, whatever it is, at the hotel, wherever you're at, whatever scenario you're in, you have this tool in your pocket. Think of it as like the back of the napkin type conversation that is just a little bit more tech driven, where you put their age in, you put their gender in, you put their whatever their retirement account balance is at the time, hit calculate, and it spits it out for you. Throw their name, put your email in, email it to yourself, forward it off to them. Real cool way to be able to get to a deeper conversation. What really shows up is this right here. What gets their attention is the taxes that are paid by the client if you leave the money in the retirement plan. That's what's going to get their attention, because they haven't really thought about that. They really just haven't done the math and put much thought behind that. And it really always catches them by surprise. All right. Enhanced tax advantage parameters. $500,000 minimum distribution. That's the standard minimum. We have been able to get some exceptions, particularly the exceptions have been done primarily with folks inheriting qualified retirement plans. So younger individuals, you know, I think we had a 38-year-old that inherited like a retirement plan that had like $430,000 in it. Okay, that's a real easy exception to get done at the carrier and the lender. That's really where we're going to be seeking the exceptions. Must have insurable interests. The reason why I share this is perhaps the person whose retirement account it is might not be insurable, right? They might have some health issues, whatever it may be. So we could put the policy on the spouse, right? Maybe they're older, right? Maybe they don't necessarily need the income. Maybe they're a little older. It might not necessarily make sense for them. We can put it on adult kids. There's different ways for us to be able to address that, you know, any type of insurability issues. Needs $1 million of liquid net worth. We're not going to utilize more than 50% of their liquid net worth in this strategy. We do not want to liquidity strap anybody. This is about layering buckets into other, and you know, to be able to fit into an overall strategy. This is not replacing any complete strategy. This is layering another bucket into the strategy. 70 years or younger is really where this is going to make sense. I just mentioned if they're older, you know, individuals. We had a 73-year-old lawyer that didn't need the income, was staring RMDs. You know, he was 72, staring RMDs down. You know, didn't really want to deal with that. 3 adult daughters, ultimately kind of create a different way to be able to utilize life insurance, right? Put the life insurance policies on the daughters, finance the tax, distribute the money into the plans. They can own the policy still, they can control them, they can put them in trust. A lot of flexibility there. You know, if there's questions on that, we can certainly dive into that. Participation. This is the key to this entire thing. Is participation is really everything. So the key to retaining more value is the participation. So the IRS is the equity partner that no one wants, right? They're going to take their cut at some point, and tax erosion can stunt the growth and really impact the future income and the outcome, right? So enhanced tax advantage provides full participation in the distribution. It continues to participate through life. So you take a distribution from the qualified retirement plan, you have a liquidity event, you sell a business, you sell a piece of real estate, you have, you know, some type of gross liquidity event that has a tax consequence. We can allow that entire gross liquidity event to participate, and it continues to participate for life. key factors, the tax liability is financed by the bank, right? This allows for full participation in the distribution. Participation continues to participation continues with the life insurance company refinances the bank loan, right? So we're not. So just one key thing I think to be able to really dig in here is that when we take a policy loan, we're taking a loan against policy values. We're not withdrawing money out of the policy and losing the compounding benefit of that amount. It remains. So we're taking a loan against the policy to pay back the bank. And then that policy loan that it is owed to the insurance carrier is paid back out of the gross death benefit. Right. So these are all things that I think is really important to be able to digest and really hold in as a just to be cognizant of time. And I keep moving pretty quickly here, but we're going to send this. We can certainly share this presentation and share this recording in the future here. That was enhanced tax advantage. I'm going to move to another strategy called enhanced pension, but I did want to give, I haven't seen any questions in the chat. Rich, just add one. Just before I move on from enhanced tax advantage, is there anything related to enhanced tax advantage that anybody wants to chime in on right now before we keep moving? Good. All right, cool. So we rolled out enhanced tax advantage. We got some feedback from business owners. There's some things I like about my qualified retirement plan. I like the fact that I can get a deduction, right? A corporate deduction on my qualified retirement plan. So can you come up with something that works very similar and gives me similar benefits of my qualified retirement plan contribution without the headache of a qualified retirement plan? That's what we're going to do here. All right. So what we've got is, I'm going to blow through qualified retirement. We've already touched on a lot of these. The thing that's different here that we're going to talk about that's a little bit different is obviously corporate tax deductions. That's one of the benefits of qualified retirement plans. So cash balance plans, right? That's real for anybody that has any experience with utilizing cash balance plans. Huge benefit of cash balance plans. You're able to deduct a significant amount with the contribution made to those plans, right? Obstacles to achieving financial goals, efficient access to capital, taxes. These are all some things that a lot of things that we've already kind of hit on. Again, I'm going to keep moving pretty quickly here just to be cognizant of everybody's time here. Qualified retirement plan limits, right? Not saving enough. Folks that want to put more away. We're going to talk a little bit about highly compensated employees as well on the back end of this as we wrap up. This can be, keep this one in mind, not saving enough. So we have some physicians that ultimately are contributing to 403Bs, 401Ks, profit sharing plans, doing what they can on a pre-tax basis, but they want to do more. Keep that in mind a little bit as we go through and look at what we're going to talk about here. Some business owners, might not necessarily want to do a qualified plan because of it doesn't make sense because of the amount of employees they have. Right. And so they're already doing a lot and they want to be able to do more to be able to save more for themselves and their family. And they've already got a qualified plan that they've done for their employees. But how do they accomplish this without losing more of the potential savings that they could do for themselves? So we're going to hit some of these things here with enhanced pension. So enhanced pension is having tax efficiencies on the front end with tax-free income on the back end. Tax liability participate and compounds for the growth of life. I jokingly kind of say that enhanced tax advantage and enhanced pension is kind of like Mexican food, right? You got burritos, enchiladas, tacos, kind of similar ingredients, but just packaged a little bit differently on the front end. So you're going to see a lot of similarities between the two here, and that's the reason why I'm going to be able to flow pretty quickly here. Enhanced pension, we're going to talk about it first with business owners. It can be C Corps, S Corps, LLC, single members, multiple partners. This is awesome with family-owned businesses. Mom, dad, son, daughter, all working in the business. We want to figure out a way to be able to retain more value from, you know, what's happening in the company with the family. This is a really great way to be able to do that. So here's an example, 47-year-old male. We've got $150,000 of annual compensation that's going into an enhanced pension. We're going to use that same as a contribution into this qualified retirement plan if we could do this. Now, you might run into, for the amount of time that we're able to do this in enhanced pension, you might run into some excise tax issues on the qualified retirement plan on some type of defined benefit plan, right? But we're going to just say that you can do it. And you're going to give them $150,000 of contribution into this qualified plan annually. At 65, we start to take voluntary distributions. We're pulling out $177,000, almost $178,000 taxable. You got $70,000 is the tax consequence on that distribution, and you have the after-tax income of $107,000. Age 86, we got $5.4 million of cumulative taxable withdrawals from this qualified retirement plan. You've paid $2.1 million in tax to get that money out, and you're able to hold on to $3.3 million after tax. $2.1 million of tax. Enhanced pension, same age, age 65, we're going to pull out $280,000 tax-free. Cumulative amount by age 86, $8.5 million. The $5.2 million increase. We don't have to include employees, right? You do here. You have to deal with taxes on the back end. Who knows what the tax rates are going to be? We're getting the tax man out the way here, right? A lot of big benefits here. Again, I'm really not even talking about a death benefit, though. I haven't even mentioned what a death benefit was here. That just happens to be the asset that we're using to be able to secure the tax code. Just like Enhanced Tax Advantage, we also have a calculator for this one too. It's at Enhanced Pension. Very easy to be able to use. This is more set up for business owners, the one that we're looking at here. But we'll also use this with with highly compensated employees, right? So physicians, attorneys, dentists, CPAs, all types of, corporate executives, folks that want to put more money away tax efficiently without having to deal with paying the tax to be able to invest it in a taxable investment account, right? This is just another bucket to be able to pull from, to be able to utilize in the future with tax efficiencies, right? They maxed out their profit sharing plan. There's nothing more that they can put in. This is a way for them to be able to do that. So here's the comparison. We got a 47-year-old, right? $150,000 of the annual compensation we're using for this particular example. And the comparison here, instead of a qualified retirement plan, which is a highly compensated employee, they're not going to be able to put $150,000 into a qualified retirement plan, right? So what is their alternative? Their alternative is to pay the tax and invest the difference, right? So $90,750 is going to go into an investment account, a brokerage account, a taxable investment account. And so at age 65, we're going to take income of $107,000. At age 86, they're going to take a cumulative amount of $3.2 million, almost $3.3 million. They're going to pay total taxes on the income that they've taken and the capital gain tax that they are going to experience over time. And I just use long-term capital gains rates on the gains only. Almost $1.5 million. In comparison, at age 65, they take $280,000 of tax-free income using the same gross money, right? 150 going into an enhanced pension, 90,750 going into an investment account, $8.5 million coming out. We're not making an argument for this to be the only thing they're doing. This should just be, something to consider, a portion, a bucket to consider to be in alignment with some of the other initiatives. We also have a calculator for the highly compensated employees, right? So going into an investment account, they pick their tax rate, they put their contribution amount, they have their age, their gender, spits it out real quickly. Just a nice tool to be able to help socialize the value, just to have a deeper conversation about this. For the process on enhanced pension, we're going to contribute the taxable annual compensation, $150,000. So for the business owner, Maybe they take additional W-2 salary. Maybe they just bonus themselves in a dividend. However they want to take that compensation, they take compensation as an individual. Again, forcing taxation. Bank finances the individual tax liability related to that compensation they just received. So $150,000 of compensation, 37% tax rate, that's $59,250. Bank finances that tax. Insurance company refinances the bank in the future. The same thing that we talked about in enhanced tax advantage. The tax liability that is financed continues to participate. Continues to participate even when the insurance company gets involved and refinances the bank. Total tax-free income of 8.5 million bucks. Insurance company's loan is repaid, just like an enhanced tax advantage out of the gross death benefit when the insured passes away. But the liability that is financed continues to stay within the asset, within the solution, and compounds for life. Some of the benefits with an enhanced pension: it provides client or CPA new tax efficiency. They're seeking and searching for tax deductions, right? What is the point and purpose of a tax deduction? Is to not pay tax today. Some of the downside about taking a deduction historically with qualified retirement plans is that it's a tax deferred asset, and we've already gone through what the complications that comes along with that. The reason why you want a tax deduction, or the primary purpose of a tax deduction, is to not pay tax today. The bank is financing the tax today in enhanced pension. Client is still not paying tax today. Limitation is only insurability. So you're not capped by some type of qualified plan rules and regs, right? You don't have to have limitation due to the amount of employees for the business owners, or the caps on contribution limits into qualified retirement plans. You eliminate the cumbersome nature of a qualified plan. We're using pre-tax dollars to be able to fund tax efficient assets. You're getting tax efficiencies on the front end, and you're receiving tax-free income on the back end. Where else can you say that? Where you're getting tax efficiencies on the front end and getting tax-free income on the back end. Enhanced pension parameters: $100,000 minimum annual. For family-owned businesses, we use this often. We'll make that $100,000 minimum as a family, right? So you got mom, dad, son, daughter, all in the family business, $25,000 a head, or however else they want to split it up. We can make sense of that, and the bank can make sense of that because it's all one loan. Must have insurable interest. So if you have a business owner that's unhealthy, you have a physician, which I've seen a lot that are unhealthy, and they want to take advantage of a situation like this, you can put the insurance on a spouse, we can put the insurance on an adult child. Just must have insurable interest. $1 million liquid net worth, or at an absolute bare minimum, $200,000 of AGI. Okay, it's not a combination of both. It's or. Age 65 or younger for this strategy, for it to make sense. All right, I've talked a lot about benefits. Rich hit on one of the negatives earlier. I'm going to bring it back up. But this is some of the perceived negatives with enhanced tax advantage and enhanced pension. I think it's only fair to be able to lay that out. The first and foremost, I think the only drawback is that it takes time. It takes time to get the money into the program in a very creative way. We can certainly go into that on an individual basis if it makes sense. If you're interested in learning more, it takes time to get the money into the solution. And so at a minimum, you really need to allow the program to work for 10 years before you start to take income. For enhanced pension, I think that is a moot point for the business owner. The business owner that is on the younger side of things, and when I say younger side of things, even 50. If they're 50, they're not going to take access to anything in their qualified retirement plan before 59 and a half anyways. So I think it's a little bit of a moot point for enhanced pension. For enhanced tax advantage, that's where you got to be careful. and that's the distribution, specifically with distributions from qualified retirement plans. You got to wait for 10 years. And so what we suggest doing is layering assets, right? Look for, put assets in place that ultimately are accessible today. That if money's needed in 5 years, this is not the solution on a standalone basis to consider. Put money in assets that you have access to efficiently in a shorter period of time to be able to accommodate that need, and use this as more mid to long-term money, right? So we already talked about Richard, which was my Vanna White a little bit earlier. We already hit on lender interest rate risk, right? And so we've got that already buttoned up. I've already explained that, right? Short-term interest rate risk versus long-term interest rate risk. Policy loan as the rate hedge, long-term interest rate hedge. The other one to consider is, what about index performance? This is an index universal life policy, is the type of life insurance policy we're using. One of the benefits that we've already harped on in this conversation has been the fact that we can backtest that index universal life insurance policy to be able to show how volatility can impact the policy performance. But in down years, of course, that can impact the outcomes that we've been looking at throughout this entire presentation. So if the previous 40-year period is more favorable than the next 40-year period, is my point, then we're going to have not as great of an outcome as what we've seen so far. But really, then the question has to go to, you can't look at that in a vacuum. What about comparing it to other assets without guaranteed protection? Right? We have a guaranteed floor in the index universal life insurance policy due to, frankly, them being able to risk pool with the life insurance program, right? Looking at different assets to be able to create advantage for a larger number of people. But in doing so, what they've done is created a guaranteed product that has a 0% floor. So in a market correction, again, I'm bringing back up March 2020, you have a 20% correction. What did the 401ks and IRAs do in that year? Like, you can set them up and structure them in a way that can, really create some balance and diversification, but it's still going to get hit in that type of scenario. IULs, your risk exposure was at zero from a market risk standpoint in that month. So that is, I think, a little bit of a muted point when you compare it beyond just looking at it in a vacuum. Look at it in comparing it against different assets, right? And then just real quick as we wrap up here, again, I'm getting down to the minutes. I actually kept on schedule pretty good here. How we work with advisors, just share this real quick. Typically, we do majority of our stuff is joint work. We work with other advisors in a very, I think, a really good way. We'll provide custom illustrations, some proposals. You haven't even, like, really, you've just seen the tip of the iceberg today. We can certainly dig into a lot of data and numbers, and turn over as many stones as anybody really wants to, and really create a good view into how not only our programs work, but also to how a life insurance policy can work in different volatility environments. We'll assist and handle and work with guys like Rich and doing point of sale and really engaging and educating the client, and then obviously provide annual updates. And so that's it. That's the presentation. Again, I don't, we have a couple minutes here, at least on the scheduled time. If there's any questions, I'm happy to take questions. I'm happy to, if anybody, I got a few extra minutes beyond the hour. If anybody wants to dive a little bit deeper into some detail, but I think that this was probably a good opportunity to be able to, give a good overview of the two programs that we discussed today.
Yeah, I think that's a good idea, Jeff. And certainly if there's any questions, go ahead, let's hear them. But if you could, Jeff, it will go a few minutes beyond here. If you could pull up one sample case and not go through row and column, but just what I'd like to demonstrate for whoever can stick around here for a few minutes. And if you can't, follow up with me. I will run you through a sample plan. We'll just set up an individual time. I'll take you through the last client that Jeff and I worked on and show you from start to finish how a case works and everything that's involved. But Jeff, one of the questions I was going to ask, and you can show us here just by pointing to a sample case, the numbers are significantly better with these strategies. And naturally, people might ask the question, is that because you're using better assumptions on your side of the ledger? And I know what the answer is. You're applying the same set of returns to their current plan with either ETA or EP. If you could pull up a plan here and just kind of show them how you are able to apply the same sequence of returns in their current plan versus ETA as an example, subject to the confines of IUL. So if you could just take 2 or 3 minutes without all the details and just say, how do the numbers work in this context?
Yeah. So this is the enhanced tax advantage, the distribution from the qualified plan example we walked through in the presentation. And this is to Rich's point, I think what's traditionally done is, hey, 6% gross versus, or 7% gross versus, 6% net, whatever, the assumption, average static assumption for two different assets that frankly behave very differently. The qualified plan here, and just as an example, we're using this for this particular setup, and these are all levers that we can pull. We're using a 60-40, your kind of standard assumption on the allocation. We're using the S&P 500 with dividends for the equity return. We're using the 10-year T-bond just to represent the bond return. And then we're using the tax rate that I mentioned at 37%, right? And then we've got a 75 basis point management fee. So, and then we just layer the sequence of returns that happen in this 40-year period. I mentioned also too that we do different time periods, right? So just to get a real quick flavor of that, here it is from the worst 40-year sequence in the last 50 years. Started in December 1st of 1972. But going back up to what we're familiar with and what the numbers that we've seen so far in the presentation, this is all it is layering it in and letting the time and letting the returns do what they did. I often say when you're looking at static returns, it's financial fiction, right? You're looking at an assumption rate of 6% or 7%, whatever it is. Like that's not, like all of us on this call knows that's not what's going to happen. I would also argue that this in a sense is also financial fiction, but just in a little bit different way. Is that this is looking backwards. This isn't looking forward. So I mean, none of us can sit here and tell what's going to happen over the next 40 years. But the benefit here is that I think it gives you a sense of how this can impact and play on volatility in comparison to what we're suggesting over here with the enhanced tax advantage for this particular example. And using the same time period, 1983, and rolling forward over here on the IUL, the Index Universal Life Policy with enhanced tax advantage, the allocation here is the S&P 500 without dividends. Life insurance companies with IULs do not use dividends in their calculations. And so that's what we're using here in this particular example. S&P 500 without dividends, just layered it in. What was those returns from these years and how did it play out? And just use the current charges, current caps, and allowed the time and the returns and frankly the math to do its thing. And that's how we're able to come to these outcomes and these, so it's not just a lot of times when you involve life insurance in the discussion, sometimes frankly it kind of goes into this box where people just think it's like some black box and there's just some magic happening. Really, when it comes down to it, all for the most part, most carriers have to disclose their calculations on how they arrive at their crediting and how the charges are calculated. And what we've done is done the work to be able to build a platform that can take that, layer it in to an actual true sequence of returns and spit out what the outcomes could be. And so that's it.
Jeff, what you're showing here on the right hand side of this ledger is real world volatility the real returns that happen in those years, and what would happen if it was run through an IUL policy subject to floors, caps, and then all of the costs and charges inherent to an IUL policy. Is that what's being shown here?
Yes, and just my disclosure and disclaimer hat comes on for one moment, and I just gotta put it out here, especially since we're recording this, is that we are not we are licensed insurance agents that ultimately are following the rules and regulations from the insurance departments in all the states that we do business in. What we are showing here is a hypothetical asset that has similar, if not exact, characteristics of life insurance policies that we use and put in place with clients, and we're just overlaying the sequence of returns, and it has exact charges and credits and all of the calculations that are inherent in a life insurance policy that can be gathered in a life insurance illustration, and we can certainly point to that and show that and show in the math. But again, this is technically a hypothetical asset. We're not representing a specifically an insurance policy here.
Understood.
And everybody I'm sure gets that. I mean, that's just part of the deal here.
Okay, great. Well, Jeff, thank you so much for your time today. Is there a burning question anyone has that we can close with? Anyone? And if not, and speak up if you do, but if not, any follow-up, feel free to reach out to me. If you'd like to go through a sample case, if you have a particular client in mind, either for the ETA or the enhanced pension, give me a shout and I can walk you through what it might look like, and if it could be a good solution for your clients and prospects. And so with that, thanks to everyone who joined today. We'll get you some follow-up information and let you know when we're doing our next webinar in the future. So thanks to everybody. Thanks to you, Jeff. Really appreciate it, and enjoy the rest of your afternoon.
All right, guys. Take care.